Hi, Zach Scheid here with the Rich Retirement Letter. There's an old Wall Street proverb that says markets tend to climb a wall of worry. In other words, when investors are worried about some of the concerns that are on the horizon, that's when stocks tend to move steadily higher day after day and week after week. And this is exactly the type of situation we're in right now. Think about it. If you open your newspaper or click on any financial website, you're going to see a lot of things to worry about. We've got higher inflation, which makes people worry about whether they're going to have enough money to spend to cover their day to day expenses. We've got people worried about higher interest rates. And when is the Fed going to raise the interest rates? And is that going to cause a problem for the economy or for the market? We've got home prices that have been moving steadily higher. And while that helps create wealth for some people, it also makes it more difficult for other people to find the homes that they want to live in. Stock prices, are they becoming expensive? A lot of people think that we're in a bubble. Maybe we're going to have another pullback in the market. And do we need to be worried about that? And then there's issues in Washington, like the debt ceiling. What happens when we actually reach the debt ceiling, and are we going to be able to extend that? Are we going to be able to increase the amount of debt that the U.S. can borrow? And if they do, what does that mean for the long term? How bad is this borrowing going to hurt future generations? Think about the Delta variant. With the coronavirus crisis, we finally kind of came out of the crisis, and now the Delta variant makes us worried about what's going to happen next, and are there going to be more variants, and how contagious is this? In other words, there are no shortage of things to worry about right now, and yet the market continues to make new highs. Every day we're seeing the S&P 500, the Nasdaq, the Dow. It seems like every day we're seeing new highs in these indexes. But one thing I wanted to point out is that even though the stocks are moving to new highs, the market in general is becoming actually less expensive when compared to earnings, the profits that these companies are generating. And that's a good thing. So, what has been happening is that companies are reporting stronger earnings as the economy reopens, and management teams are actually telling investors to expect higher earnings in the future. So, for the rest of this year and into next year, projections for profits are moving higher, and they're moving higher at a rate that's faster than stock markets are moving higher. So, while the stock market hits a brand new high, you're actually paying less per dollar of earnings for every company or for most of the companies that you invest in than you would have been paying a few months ago or even a year ago. So right now, with the stocks becoming less expensive, with this wall of worry helping to drive prices higher, the best thing to do is to buy quality stocks that are really underappreciated right now, so that as all the people who are worried and they're out of the market, as they start moving their money back into the market, those are the names that they'll likely buy, and it'll help to push the stock prices higher. So one of the names that I think you can focus on in this environment right now is Procter and Gamble. Now, Procter and Gamble sells all the different types of consumer products that we buy on a day-to-day basis, and they're actually going to benefit from strong consumer spending throughout the end of this year and into next year. Now, people have a lot more money to spend because there's been a lot of government stimulus programs that have put money into consumers' pockets. And at the same time, the job market is very strong, and people are able to expect wage increases, whether they get a raise from their current employer or whether they go across the street and get a new job for a higher salary or a higher hourly wage. So consumers have a lot to spend, and they're going to be buying the things that Procter and Gamble has to sell. Now, shares of PG actually traded about 22.3 times next year's expected earnings. And so it's a relatively inexpensive price compared to some of the premiums that we've seen in other stocks and at other periods of time. And Procter & Gamble expects to earn about $5.63 per share this year, which is up 10% over last year. And the next year, they're expected to grow those profits even more. We could see the company's management team revise their expectations even higher. That's been a trend that we've seen over the last several weeks and several months. So as those revisions move higher, it should naturally lead more people to buy shares of PG and keep driving this stock to new highs. Now, one of the things I like about Procter & Gamble is that if you buy the shares right now, you're getting an 87-cent quarterly dividend, which is the same as a 2.4% yield. So you're getting paid along the way to hold this stock while shares are expected to continue to move higher. And considering how much money the company's earning, there's plenty of room for Procter & Gamble to increase their dividend in the future to help give you more income for the investment that you make today. So that's one of the ways that I would play this wall of worry, and I would continue to look for other names that you can invest in right now that will benefit as investors who are worried decide that their worries, maybe they're being too skeptical, and they start to move money back into the market and keep pushing this market to brand new highs. I'd love to hear what you think about this stock, about this video, or about what's going on in the market. Please send me an email at richretirementfeedback@stpaulresearch.com, or just leave me a comment on this video.